When financial systems crack, governments always promise they have the solution. They roll out rescue plans with impressive names, pledge trillions in taxpayer money, and assure everyone that stability will return. The 2008 bailout was supposed to be different. Politicians called it the Emergency Economic Stabilization Act. Wall Street called it salvation. Main Street called it a robbery. But here's what nobody wants to admit. It didn't actually solve anything. It just bought time. And that time is running out. The Troubled Asset Relief Program, or TARP as it became known, was sold as a $700 billion lifeline to prevent economic collapse. The Treasury Secretary stood before Congress and warned that without immediate action, the entire financial system would crumble. Banks would fail, credit would freeze, and ordinary Americans would lose everything. The fear was real, the panic was genuine, but the solution was a band-aid on a severed artery, and now the bleeding is starting again. What made 2008 terrifying wasn't just the scale of the crisis. It was the realization that the institutions everyone trusted were hollow. Investment banks that had existed for over a century vanished in days. Insurance giants that seemed too big to fail collapsed overnight. And the Federal Reserve, which was supposed to prevent such disasters, had to admit it was out of conventional tools. The system that promised safety had become a house of cards, and when the wind blew, everything toppled. But here's the part that should keep you awake at night. The rescue plan didn't fix the underlying problems, it papered over them. Banks that were too big to fail in 2008 are now even bigger. Debt that was unsustainable then has exploded to levels that make the previous crisis look manageable, and the government's ability to mount another rescue has been quietly but systematically destroyed by the very policies that were supposed to prevent the next collapse. The numbers tell a story that politicians would rather you ignore. When TARP was authorized, the national debt stood at roughly $10 trillion. Today, it has nearly quadrupled to over $38 trillion. Interest payments alone now consume more of the federal budget than the entire Defense Department. Every day, the government borrows more money just to pay the interest on money it has already borrowed. This isn't fiscal policy, it's a Ponzi scheme dressed up in economic jargon. And unlike 2008, when the Federal Reserve could cut interest rates to near zero and print money without consequence, the tools that saved the system last time are either exhausted or unusable. Interest rates have already been raised to combat inflation, leaving little room to cut them again. The money supply has been expanded so dramatically that printing more risks destroying the dollar's credibility entirely. The ammunition that policymakers relied on during the last crisis has been spent, and the enemy is marching toward the gates again. What's coming in 2026 isn't just another recession, it's the reckoning for 16 years of kicking the can down the road. Every bailout, every stimulus package, every emergency intervention since 2008 has made the system more fragile, not stronger. The banks that were saved became more reckless, knowing they would be rescued again. The government became addicted to spending beyond its means, confident that someone else would always buy its bonds. And ordinary Americans were told that rising asset prices meant prosperity, even as their wages stagnated and their cost of living soared. The warning signs are already flashing. Corporate debt has reached record levels, much of it in the form of risky loans that wouldn't have been made in a saner era. Commercial real estate is collapsing as office buildings sit empty and retail spaces go unleased. Regional banks are failing at a pace not seen since the savings and loan crisis of the 1980s, and inflation, which was supposed to be transitory, has become embedded in the economy like a parasite feeding on the host. But the most dangerous element isn't visible in the headlines. It's the loss of confidence in the system itself. In 2008, people still believed that government intervention could work. They trusted that the Federal Reserve knew what it was doing. They had faith that America's economic leadership would find a way through the crisis. That faith has been shattered by years of policy failures, political dysfunction, and the growing realization that the people in charge are either incompetent or corrupt. When the next crisis hits, and it will hit, the usual playbook won't work. Congress won't be able to authorize another massive bailout because the government's credit is already stretched to the breaking point. The Federal Reserve won't be able to print its way out of trouble because inflation is already raging and the dollar's status as the world's reserve currency is under assault from rivals who see America's weakness. And the American people won't accept another rescue of Wall Street while Main Street suffers because they've learned that the benefits of these programs flow upward while the costs flow down. This isn't pessimism, it's arithmetic. When you borrow your way out of a debt crisis, you don't solve the problem, you make it bigger. When you bail out institutions that should fail, you don't create stability, you create moral hazard. And when you promise that this time is different while repeating the same mistakes that caused the previous disaster, you don't inspire confidence. You guarantee catastrophe. The 2008 rescue plan worked, in the narrow sense that it prevented an immediate collapse. Banks were recapitalized, markets were stabilized, and the economy eventually recovered. But it worked the way a painkiller works for a broken bone. It numbed the pain without healing the injury, and now the bone is shattered beyond repair. What makes 2026 different is that the injury has metastasized. The problems that caused the 2008 crisis have grown larger, more complex, and more interconnected. The solutions that worked then are no longer available, and the political will to implement painful but necessary reforms has evaporated in a cloud of partisan gridlock and special interest capture. The government's fiscal position has deteriorated so dramatically that it can no longer credibly promise to backstop the financial system. Foreign creditors who once eagerly bought American debt are now hedging their bets, diversifying into other currencies and assets. Domestic investors are demanding higher yields to compensate for the increasing risk that the government might not be able to honor its obligations. And the very institutions that were saved in 2008 are now so large and interconnected that their failure would be even more devastating than it was 16 years ago. This is the trap that every empire eventually faces. The cost of maintaining the system grows faster than the system's ability to generate wealth. The debt required to fund current operations crowds out investment in future productivity, and the political pressures to maintain the status quo prevent the reforms necessary to restore sustainability. Rome faced this trap. Spain faced it, Britain faced it, and now America is staring into the same abyss. The question isn't whether the system will fail, the question is what happens when it does. Because unlike previous crises, where failure was followed by recovery and reform, the next collapse might not offer a second chance. The resources needed for reconstruction might not exist. The international cooperation required for stabilization might not be available, and the social cohesion necessary for collective action might have already dissolved in a toxic stew of inequality, polarization, and despair. The parallels to history's greatest financial collapses are impossible to ignore. Every dying empire tells itself the same lies. Every failing system insists that this time will be different. But the mathematics of collapse are ruthless, and they don't care about political promises or economic theories. When debt grows faster than the ability to service it, when money loses its anchor to reality, when institutions become too corrupt to function, the outcome is always the same. The only variable is timing. America, in 2026, will face what economists politely call a liquidity crisis, but that sanitized language obscures the brutal reality. When the government can no longer borrow at reasonable rates, when foreign creditors start demanding real assets instead of paper promises, when domestic savers realize their bonds are worthless IOUs, the entire structure comes apart. Not gradually, but suddenly. Not partially, but completely. The Federal Reserve's balance sheet tells the story in numbers that should terrify anyone who understands what they mean. In 2008, the Fed held roughly $800 billion in assets. Today, that number approaches $8 trillion. The central bank has become the buyer of last resort for government debt, corporate bonds, and mortgage securities that no rational investor would touch. This isn't monetary policy, it's financial alchemy, and like all alchemy, it promises to turn lead into gold while delivering only smoke and mirrors. When the 2008 crisis hit, the Fed could expand its balance sheet because it was starting from a relatively clean position. There was room to maneuver, space to absorb losses, credibility to burn. But 16 years of emergency measures have consumed all of that flexibility. The central bank is now so leveraged, so exposed to toxic assets, so dependent on continued confidence in its solvency, that any serious shock would expose its fundamental insolvency. And the shocks are coming. China is actively working to replace the dollar as the world's reserve currency, creating alternative payment systems and encouraging its trading partners to settle transactions in yuan or other currencies. Russia has been forced to develop similar systems after being cut off from dollar-based markets. Even America's closest allies are quietly reducing their exposure to dollar-denominated assets, recognizing that the currency's dominance is built on foundations that are crumbling. The repo market, which most Americans have never heard of but which is essential to the functioning of the financial system, is already showing signs of stress. This is where banks and financial institutions borrow money overnight using government bonds as collateral. When this market freezes, as it briefly did in September 2019, the entire system seizes up. The Fed was forced to intervene with hundreds of billions in emergency lending, a preview of what's coming on a much larger scale. Corporate America has gorged itself on cheap debt, using the money not to invest in productive capacity, but to buy back shares and pay dividends. Companies that should have been allowed to fail during the pandemic were kept alive with government loans and Federal Reserve bond purchases. The result is a zombie economy filled with enterprises that cannot generate enough cash flow to service their debts, but are prevented from failing by artificial life support. The commercial real estate sector is particularly vulnerable. Office buildings across America sit empty as companies embrace remote work. Retail spaces remain vacant as consumers shift to online shopping. The loans that finance these properties are coming due, and the buildings are worth far less than the debt they secure. Regional banks, which hold much of this commercial real estate debt, are facing losses that will dwarf the savings and loan crisis of the 1980s. State and local governments are equally fragile. Pension obligations that were underfunded during good times have become impossible to meet as investment returns disappoint and retirees live longer than expected. Cities and states that borrowed heavily to fund current operations now face a choice between defaulting on their bonds or cutting essential services. Either option leads to social unrest and economic disruption. The international dimension makes everything worse. In 2008, foreign central banks coordinated their responses, providing dollar liquidity to their domestic banks and maintaining stability in currency markets. But the geopolitical landscape has changed dramatically. America's relationships with China and Russia have deteriorated to the point where cooperation is impossible. European allies are focused on their own problems, from energy shortages to migration crises to the ongoing fallout from Brexit. When the next crisis hits, America will face it largely alone. The network of swap lines and cooperative agreements that helped stabilize the global financial system in 2008 may not be available. Foreign central banks may decide that protecting their own currencies is more important than supporting the dollar, and without that international cooperation, the collapse will be faster and more severe. The psychological element cannot be ignored. Markets run on confidence, and confidence in American institutions has been steadily eroding. Each failed promise, each missed target, each emergency intervention that becomes permanent policy chips away at the credibility that underpins the entire system.